crypto market lost billions in 48 hours after one Trump tweet, and the chaos from the second presidency is just getting started. But don't panic, because volatility means opportunity. And in today's video, I'm sharing a straightforward framework you can use to start finding investments when it feels like nothing makes sense. Hi, I'm Marconi White. I make investing in the future of finance easy to understand. And in this video, I'm revealing Trump's blueprints for a new financial world order, unpacking the chaos-proof investment framework W3, and showing what the data says about where to invest. And stick around to the end, because I'm going to share 3 portfolios you can use to play this crazy period of Trump turbulence, whether you're new to the market or already a millionaire. Maneuvering through chaos demands simplicity. Unfortunately, many choose to do the opposite. They become hyper-focused on complex models and data such as policy reaction frameworks, liquidity and macro positioning, geopolitics. But in truth, making sense of chaos is about analyzing fewer data points, but ones that have a higher likelihood of being closer to reality. Because otherwise you become overwhelmed with the amount of data you're looking at as it changes, and it happens so quickly, changing on a weekly, daily, maybe even an hourly basis. In chaos, less is more, maybe 10 times more. Here's the simple framework that tries to boil all this down. We're going to look at what does Trump say, what does Trump do, and what does it all mean? All right, let's get to it. What does Trump say? Well, it's Trump. He says a lot.
Billions and billions and billions.
And most of it's blown up so big it feels like he's trying to reach space with a hot air balloon. Now, one of the comments, though, really caught my eye because we've seen it before, and it led to bull runs where investors made millions, even billions of dollars. It's cutting regulation and red tape. What if I told you that 2 major financial booms the last 50 years started with some reduction in red tape? You have the 1980s, where Ronald Reagan came in swinging, cutting regulation, red tape across banking, transportation, and telecom. The results? Well, it unleashed the economy. Fast forward to the 90s, and Bill Clinton passes the Telecommunications Act of 1996, paving the way for the internet age. The takeaway? When industries are freed up, money and innovation follows, and investments in those areas can do really, really well. And when you're looking for investments that will outperform the market, we want industries that have been held back the most by regulation, lack of clear guidance, unfair targeting, and in some cases, flat-out harassment. And of course, one industry stands out above them all. That's crypto. And Trump has already said he wants to create a path for normalization of this industry. That's a 180-degree difference from the last 4 years and really even the last 10. Okay, so that's what Trump says. Now we got to understand, what is Trump doing? Well, the short answer, he's made a $120 million investment in crypto. But the longer answer is way more interesting. Trump's crypto investments outline his blueprint for reworking the global financial world order, from government debt to financial products to the US dollar world reserve status. He wants to make each of these more US-centric, with crypto as a central piece to making this a reality. So what has he done for crypto? Well, since being in office, he's established crypto as a national priority, supported the development of dollar-backed stablecoins, and prohibited CBDC. He's issued guidance for banks for how they hold crypto, making it easier for them to do so, nominated a head of Treasury who wants to bring down debt, also happens to be a Bitcoin bull, and announced a congressional push for crypto regulation. Now, all those are very much pro-crypto, but from an investor point of view, I noticed something very interesting about the cryptos Trump purchased through World Liberty Financial. And when you pull this picture together, it becomes clear Trump's blueprint for America relies on the successful adoption of crypto to achieve 3 things: attack government debt by adopting digital collateral, drive economic growth through financial innovation, and maintain U.S. supremacy through dollar domination 2.0. So what are each of these, and how can you invest in each one? Let's start with the straightforward one. Digital collateral to attack government debt. Now, collateral is just an asset that acts as a guarantee for loan repayments. And the idea here is really, really simple. Bitcoin becomes the first digital asset or commodity to achieve collateral status. And why this idea is interesting is because, unlike other forms of collateral that are relatively stable in price, Bitcoin is still in its adoption phase, meaning price appreciation for the collateral. And this can act as a tool to help pay down debt. And this idea is just beginning to gain traction.
That's right. Term financing.
Term financing. And how long's the loan? Just
10 years.
10-year loan. Okay.
That's right.
At above market rate or below, or what's
no
the
market rate interest rate?
I'm just trying to slow the whole thing. Okay, now let's introduce the Bitcoin piece into it.
That's right.
So no, explain how the Bitcoin piece
And
And
why?
relate. So the loan has been provided.
The use of proceeds is to pay off the existing financing. So
The use of the proceeds
of the loan
of the loan.
is to retire the existing mortgage.
Right. So there's an old mortgage.
Gone.
They're going to pay the old mortgage
That's
off.
been paid off.
Okay.
Now they have a little bit extra money to make some improvements in the property.
Right. So a
And-
little bit extra cash. So the amount of money you've lent pays off the old loan.
That's right.
It's also has you have a little bit extra to fix
Improve
stuff
the
up.
property, fix
Okay.
stuff up.
Yep.
And then with the remainder, which is a little bit
So you
more.
have even a little extra, an
That's
extra
right.
turn.
And that, instead of cash out, it's
Uh-huh.
Bitcoin in. And we use it to purchase some Bitcoin and add it to the collateral package of the loan. So now our loan is supported by both the traditional asset, the 63-unit apartment building,
Right.
and the Bitcoin.
Okay.
So the loan, it was maybe $2 million more. So that's
So this part of the blueprint is super straightforward. Adopt Bitcoin as collateral, use it to pay down debt. Now, the next leg is more complex and beefier and might actually serve up even greater investment opportunities, economic growth through financial innovation. So financial innovation is using new technologies and methods to work with the four elements of finance to achieve new and better outcomes. For example, our ancestors used grain silos to store wheat, creating a way to store value for a later date, a type of primitive savings account. And Lloyd's of London began as a coffee house where ship owners pulled money to cover losses from shipwrecks, the beginnings of insurance. And public blockchains and financial protocols offer a new frontier for financial innovation, one that adds a new element, universal access. And Ben Lilly explained why this is just so amazing.
Selling point for Ethereum. And it's sort of this ability to take, an asset and digitize it and put it on chain and then really allow it to interact with all these different financial primitives, right? And then create kind of these unique, building blocks, using Legos to create this composable.
So by signaling that regulatory clarity is coming for DeFi, you're opening up the financial economy for an amazing amount of innovation, the ability to move at the speed of development, not regulatory hurdles. And that's where assets like Ethereum and Aave and Link and other DeFi protocols can really shine. And we haven't even scratched the surface on what AI agents might mean for this new sector. The growth potential here is truly extraordinary. The third leg of the blueprint has to do with dollar domination 2.0. And it's by far the most complex to understand. In fact, it's so complex that today I'm just going to give you a teaser, because as an investor, you likely want to know what's coming down the pipeline. Let me know in the comments if you think we should dive deeper into this topic. Trump needs to fund his ambitious projects, and he doesn't want to raise taxes. So what does Trump do? Well, he and his Treasury Secretary develop a complex strategy of tariffs and stablecoins and vague threats that encourage central banks around the world to sell their government treasuries and adopt stables as a new form of dollars, giving the U.S. liquidity while longer term weakening the U.S. dollar so it's easier to boost domestic manufacturing. And, depending on how they structure the laws of stablecoins, this could make them backed by 20 or 30-year treasuries, building in demand to finance the debt over longer periods at a lower rate. Is that clear? Listen, I said it was complex, and it's a very difficult plan, and it relies on a whole series of variables. But, you don't need to understand all this to be able to make some good decisions on where to invest. And now that you know what the blueprint is, you can ask, where do you invest and how much? So do you mimic Trump's portfolio? Do you buy the same assets, but perhaps with different amounts? Well, if it were me, I'd first ask, where can I actually invest to benefit from this move based on my own circumstances? Well, yeah, digital collateral, absolutely. Almost anyone in the world can get access to Bitcoin. What about financial innovation? Absolutely. Most of the assets that would fit in there from Ethereum, Aave, Link, and many other protocols such as SushiSwap, those are things that you can probably buy depending on where you live. Now, what about digital dollars? What about that narrative? Not really. Unless you can be part of the minting process and capture what is called Cinerage, there isn't a great way to benefit from this process. And there's a lot of risk around these as well. We really don't know how the stablecoin market is going to really pan out. So that's okay, though, because the investment opportunities in digital collateral and financial innovation, I believe, are substantial. So what are the risks involved? And by risk, there's a lot of risks that you take on in crypto. And for today, I'm assuming you know how to mitigate those. And what I'm really going to be talking about today is really the risk of volatility, right? That's all it is from an investor standpoint and thinking about it from a portfolio point of view. And today we're going to use historic volatility to calculate a balanced portfolio for a grouping of these assets. Today, I'm using each asset's historic volatility to create a risk-balanced portfolio. It means that each asset contributes equally to the overall portfolio volatility. The higher the volatility, the less you include an asset in the portfolio. And I've also calculated volatility for each basket using a full portfolio volatility formula. Now, this calculation looks both at how much you hold and the relationship between their price movements. The higher the number, the higher the volatility for the overall portfolio. And the goal here is really to have some relative measure of risk so that investors can gain a deeper appreciation for how each of the portfolios stacks up on a relative volatility basis. So here's what we see for the data for historic volatility for the 4 key assets we'll be looking at that were purchased by the World Liberty Financial: Bitcoin, Ethereum, Link, and Aave. Certainly what we're going to be talking about today could apply to other assets. I'll cover that in a moment, but these are the ones we're going to be looking at as we start to construct these portfolios. And all this data came from the Panda Terminal. It's a really great research and trading platform. You can do this analysis and a whole lot more. I mean, the opportunities are literally endless, and I'll leave a link in the description if you want to check it out. It's entirely free. So first, let's start off with the millionaires portfolio. And this is looking at someone who's got a substantial amount of capital, wants to get exposure to that upside, but definitely wants to mitigate some of the volatility. And it doesn't have to be $1 million. Maybe if 100,000 or 50,000 is a lot to you, or if you've got 10 million or even more than that, this is a way of constructing that portfolio to minimize that volatility. And when you actually run the numbers, BTC comes in over 50%, around 60%, Ethereum at 40%. So you get exposure to both of those narratives without the extreme volatility you see as we start to look at some of the other DeFi protocols that in some cases are 3 times the amount of volatility from Bitcoin. Ethereum still is a pretty substantial amount in this portfolio, and I could see definitely some investors looking to increase the amount of BTC and lowering the amount of Ethereum for let's say, a period of time. Maybe it's, the next 2 years. But I think this is a way of really balancing out that volatility while giving that upside. But what if you have less capital and you're trying to grow that more quickly? You're willing to take on more of that volatility risk with the potential to get more of that upside, perhaps in a 4-year run. Well, when you run those numbers and you include something like I've done here with Aave, you definitely see a change in distribution. BTC comes down by 10%, Ethereum comes down by a good percent, and all of that really goes then into Aave. And I'll explain why I chose Aave in a moment. But I think there's a couple points to note here. The data doesn't say to, do a 30-30-30 split. It still keeps a solid amount sitting in Bitcoin to kind of be that volatility buffer. Yes, you still have Ethereum, and a lot of that, is now going into Aave. You've kind of taken a good chunk out of that. But you're not going, above 20% even when you add in this volatility. And so this is for someone who's kind of doing a middle of the road, kind of medium risk, medium reward type of approach. And the reason that I looked at Aave, yes, it's on the World Liberty Financial. They made a purchase there, but I think it's even more important to realize that some of these DeFi protocols are closer to what we may consider blue chip investments. They've been around and they've shown substantial growth. They have consistency. You see a good amount of metrics from a fundamental standpoint. And I think Aave kind of hits that. And there are other ones that do that as well. And so when you're doing your research, I think you can probably distinguish between the ones that have at least a bit of a track record, continue to see good volumes, and ones that you could consider adding into your mix, if you will, for that financial innovation narrative that you're trying to capture. But what if you want even more exposure? What if you're saying, listen, I've got even less capital to work with. I need to have more of that risk because I want to grow this even quicker because that's the only way I'm really going to make it happen. Well, it's kind of surprising when you run the numbers, you don't change the risk that much when you're trying to do a balanced portfolio. Yes, BTC comes down by a decent amount. Ethereum, though, still stays in that 30% based on its historic volatility perspective. And then really the rest of that just goes into a bucket, which is around 30% of that portfolio. It's kind of the higher risk, higher reward. And I would kind of say if you were looking at assets outside of Aave and Link and more, going further down the DeFi protocol, using the same technique, getting the historic volatility and then being able to calculate it and bring it in here gives you a view that you're probably going to want to divide up that 30% a certain way rather than kind of increasing that. If you want to maintain that balance, again, having some buffer against the volatility, but also getting a lot more exposure to that upside. And, kind of think of this as the high risk, high reward. Why are we still talking about Ethereum? Why isn't it in any of these portfolios when it's had just horrible price performance the last 18 months? Are we just doing this because World Liberty Financial bought it? Why not have Solana in here, even if they didn't buy it? Well, The truth is, the fundamentals, in my mind, based on the analysis that we do and we talk about on this channel all the time, suggest that Ethereum is still the better play for financial innovation. Now, if you want to know why I still think ETH is still worth your attention, why it's the best, you want to understand its relationship to Athena, because it's really the reason it's keeping price down. So check out this video and then let me know in the comments if you agree. But for now, for today, this is Marconi White signing off.